I am dead weary talking about the Fed. I mean, we're talking about a 25 basis point rate hike. And I think,
right?
Market participants need to see that. But really, it's really more about the trajectory, the momentum of the rate hike. We can definitely handle that. I think it would help put a cap or at least help slow down the emerging market turbulence just to get this rate hike out of the way. But yes, I am dead tired.
And you pretty much think it's already taken into account of and priced in, don't you? You think the anticipation of liftoff has caused financial conditions to tighten beyond what a 25 basis point increase would justify anyway, don't you?
I do think that. Whether it's fully priced into the market, that's a different story. I mean, if you look at Fed fund futures, no, I would say they're pricing in a 25 basis point hike March, maybe even June of next year. But other asset classes, I do think that they need to see that. They want to see that. And especially the volatility we're seeing in the market is implying that this rate hike needs to happen in December or else.
So you think it could almost have a cathartic impact, don't you, on the markets?
Yeah, oh yes, absolutely. I do think it would be a major headwind. I mean, even though Fed fund futures are pricing in March or June, I do believe that at least with the equity market, it's going to be a headwind if they don't raise rates in December.
All right, let's go to markets. And just reading your note, you're suggesting, or your view is that the risk cycle is probably entering its final quarter. What does this look like, and how do you trade that?
It's very hard to, because we're so used to asset inflation, just given the zero interest rate environment. I do believe that the growth has been slowing. I do think in the U.S. we are carrying our weight for a while. It just can't go on forever. So when you look at the other factors, I think right now it's a good time to be tactical and not long-term strategic, lowering your expectations to single-digit returns as opposed to double-digit that we've seen over the past 3 years.
And sectors and stocks, is there anything in particular that you can tell us in terms of strategy as to what you're doing in this phase of the cycle?
Yeah, in this phase, I still like, on the U.S. side, financials and materials. It sounds crazy, but I do think the consumer will carry the day, and we're still seeing a good growth in the housing industry. But beyond the U.S., I still think Japanese equities are your best bet, followed by the Eurozone, only given that we're seeing such a divergence in monetary policy. And liquidity is going there, and I want to go where the liquidity is.
Larry, it's Gaurav here, by the way. Just going back to the US for a moment. Company profitability in the US has actually been quite high, but businesses aren't reinvesting their profits. They're building up these cash piles. What will it take for businesses to put that cash to work?
It's a great question. I think it's one of those things where we're just going to need to see the U.S. achieve escape velocity, which, as you know, we're not even close to that. Every year the GDP just misses its target. So right now, that's what we're going to need to see, maybe an interest rate hike as well to put that money to work. But right now, as you can see, we're just swallowed up in cash across the board, and profits are high. But I do expect that to stop anytime soon, especially in this earnings cycle.